Hello everyone. In this video, it is our trades back with a prediction for the US futures market coming into the week of July 14th, 2025 to July 18th, 2025. Guys, my name is Reese. I am an attorney in the state of Texas and I'm an amateur day trader. Guys, in this video, I'm going to tell you why I think the market is poised to head down from all-time highs coming up this week. Give you my reasoning behind that. Before I get into it, guys, just so you know, I could always be wrong. This is not financial advice. I am not a licensed financial advisor, and you should consult a professional for professional advice. Okay, guys, with that being said, let's head over to the chart. Let's look at the data that I've analyzed as well as what I fed into Grok 4. I have paid for a month of the latest AI model and I've fed certain data into it. I'm going to tell you what that data is and I'm going to tell you the output of that data and why that aligns with my idea that I think we're headed for a red week. First, let's start over with the chart, guys. The ES futures currently sitting at, let's take a look here. 6,300 even. We reached a new all-time high on S&P 500 futures. Let's come over to a clean chart, guys. S&P 500 futures, clean new all-time high in the week of Monday, the 30th of June. We remained at all-time highs last week with the week closing out Friday, July the 11th. You can see that we formed a small spinning top candle above previous all-time highs that we formed in December of 2024. Typically, guys, the very first thing that you look at is how is the market looking on immediate impact when you reach a new high or a new low, and it looks like this breakout is coming to a rejection. So just from a technical perspective, guys, I think that we had an impulse leg up. We reached an all-time high, and I think we're likely to see some follow through to the downside, something like this. So we can see that when we've reached prior all-time highs in the past, we get some sell-off. I'm expecting that the market's going to continue that same history from a technical perspective and sell off new all-time highs. So I am expecting a red week uh, from that perspective. Now, let's get into the data, what the data is that I analyzed, and then what the AI has to say about it. So the first thing, guys, is I've gone over to the CME group, E-mini S&P 500 futures volume and open interest. I downloaded that data. Generally speaking, guys, you can see that volume and open interest has been coming down over the week, although that everything is pretty much piled into the September 2025 expiration. A little bit of volume coming into December of 2025, but very, very small. Um, so open interest has been up over the week. Commitment of traders, guys, is the next data that I have downloaded. I downloaded using the CME Group website into a PDF. As you can see, there is a lot more leverage longs than there are shorts than there are leverage longs. So, guys, you can see um, the leverage traders, meaning speculative traders, are net short. Okay, guys, so what I have done is I have gone and inputted this data into Grok 4 that I paid for. I've downloaded the latest commitment of traders. I also downloaded the Excel spreadsheet for the E-mini S&P 500's volume and open interest. I fed that data into Grok, and then here's the prompt. Number one, I want you to speak and act as though you are an active day trader. Number two, I want you to analyze the attached data with emphasis on recent data. Three, I want you to create visual outputs of the data which are engaging and easy to understand. Four, I want you to interpret the data output to take your best guess as to whether the ES futures market should go up or down for the week of July 14th to July 18th. Five, I want you to incorporate the data I've attached here with publicly available information online and on X to inform your response. And let's take a look at what the AI had to say. Hey traders, it's your boy Grok here, grinding through another weekend setup as an active day trader who's always got one eye. This is Grok 4, by the way, guys. So this is the latest model on the charts and the other on the tape. I've been pouring over this volume open interest report from CME for ES futures and options. Looks like fresh data powered by Quick Strike, emphasizing the near-term stuff like those July 25 weekly options. Again, that's over here. Okay, that's over here. Um, and September 25 contracts, since that's where the action's hottest right now. Okay. But folks, the options flow screams caution. Overbought RSI in the 70s, double tops at 63.33. Let's take a look at that. So I'm not exactly seeing where it's showing 63.33. Oh yeah, look, there's so it's talking about a double top here, 63.33. There is your double top that the AI is referencing. And key pivot suggesting a dip. Let's break it down, visualize the key data, and I'll give you my best trade call for the week ahead. All right, guys, so this is a quick data dive. What the volume open interest report tells me, again, that this is this data downloaded. This report is all about the E-mini S&P 500 futures and American style options. Futures volume is massive at over 1.1 million total, almost all in September 25th. 1.1 million volume, 1.191 million open interest. That's the liquid contract everyone's piling into post rollover. But the real story is in options, heavy put skew across expiries, especially near-term weeklies, which screams hedging or outright bearish bets from big money. Okay, puts outpace calls in volume and open interest, particularly out of the money puts below 5,500, protection city, and at the money ish around 6,000 to 6,200. So again, if you're looking at what Grok is looking at, we're seeing a lot of put action or a lot of puts at the 5,500 strike, which would be down here on the chart. So we're seeing a lot of 5,500 puts, which are pretty significantly lower. All right. But overall, the put to call ratios are tilted bearish. Key highlights emphasizing recent data. Futures breakdown. September 25th dominates with 1.1 million volume and 1.91 million open interest, up 12,000. Longer dated like December 25th, only 2.3 thousand vol. Traders are front loaded, expecting volatility soon. So basically what you're seeing here is it's interpreting the open volume between the September and the December contracts, and because it's pretty much all in the September contract, the AI is saying that the market is expecting an increase in volatility, which I would agree with. Okay. September 25th options, puts vol 13.8K versus calls 11.1K, open interest a whopping 398K versus 158K calls, change plus 3.3K puts versus 1.6K calls, hot strikes, puts peaking open interest at 5,500, 18,000, 5,000, 10,000, 4,700, deep protection. So the AI is talking about, remember that we talked about how puts are loading up around this 5,500 strike, which is way down here. So the market is expecting or hedging for some serious downside risk. All right, if we look at what the market is hedging for, the market is hedging for a serious move down. All right, that's what people are hedging for, and you can even see that open interest has been picking up at 5,000, okay, which is way lower. So that's what the market is hedging for. Those two levels right there visualized on the chart. Okay, the data vibes with public info. Analysts such as coin price forecast see S&P hitting 59.84 midsummer, but warn of risk. Wall Street targets average 6,500 end of year, but note overbought conditions. On X, traders like Adam Mancini flagged 63.25 as a measured move target hit already, with dips to 62.50 to 62.38 likely. Charting guy calls July 5th through 15th a major pivot low. And then overall, institutions are hedging hard amid record highs, suggesting a breather or reversal. Engaging visuals, let's chart this out. To make this digestible, I've crunched the numbers into tables in a simple markdown bar chart for September 25th OI open interest skew, focusing at the money range 5,500 to 6,500, assuming current ES of 63.20. Think of it as my trading desk snapshot: green for calls, red for puts, higher bars, more interest. Okay, guys, so here we can see that um, the massive protection bearish hedge wall puts at 5,500, deep out of the money bomb, crash insurance, very small volume there. So we see the put strike at 5,500. That open interest is our largest open interest at 18,248 with 445 volume. Again, that's at 5,500. That's looking at a market going down 12%. So that's a protection for some serious downside risk. So you can see that institutions and the big money, they're betting on or hedging for a move downwards, which is why I've turned bearish as well. Okay. All right, top 10 strikes by open interest. We can see calls at our greatest open interest is at 5,500. Our next pretty much puts have all of the greatest open interest. Table 2, put to call ratios across expiries with a bearish tilt. So we can see that September 25th put to call volume ratio is 1.16. Put to call open interest ratio is at 2.52. Sentiment vibe, we can see that that's bearish, high put, open interest overhang. December 25th, we're seeing mixed. July week 4, 1.54 put to call volume ratio, which is bearish in the near term. July week 5, put to call ratio is 20.29, extremely bearish, puts dominate. Overall, it's put to call ratio of 1.25, put to call open interest ratio at 2.10, which the AI is calling hedging pressure is building, and I would agree with that. Here's a quick text-based bar for top OI strikes. Scale is relative. Puts red, calls green, clear put wall below current price, calls scattered higher. So here we can see the strike 5,500 put is 18,000, which the AI is calling as a bear fortress. We're seeing 8,000 at 6,400, which is bull hope. This screams asymmetry. Puts are stacked low for downside protection. Calls lighter and higher. Classic quote, fear the drop setup amid highs. Okay, so if you can see my visual representation of the chart here in the ES weekly, this is kind of what risk managers are hedging for, these two scenarios. All right, my best guess, ES market direction, July 14th to July 18th, 2025. All right, tape don't lie. I'm calling for down this week, targeting a 1 to 2% pullback, ES to 6,200, 6,250 before any rebound. Why? The volume open interest data shows exploding put activity, ratios greater than 1.5 near term, aligning with X chatter on overbought RSI, double tops at 63.33. Again, so let's take a look at the RSI. RSI is at 64.81 on the monthly. It's at 61.14 on the weekly using the default setting, 66.19 coming out of overbought territory on the daily. So there you go. There you have it on the RSI. My play, short ES at open. If it gaps up, stop above. All right. Let's take a look. Public forecasts are rosy, and July seasonality favors bulls, but with non-farm payrolls echoes still fresh and no major catalyst till tariffs clarity next week, institutions are hedging like crazy. Think rotation out of tech heavies. Top 25 S&P weights per Investopedia skewed to NVIDIA/Apple. It could chop sideways, but a break below 62.70 opens the floodgates to 62.38. All right, guys. So I also asked Grok to incorporate the data that it just reported along with the tariff announcements. Here is the conclusion. Tariffs clarity, more like escalation. August 1st deadline loom, but market shrugged per Atlantic. Still, this juices my down call. ES pullback 1 to 2%, 6,200 to 6,250. as trade fears rotate out of risk. Tech is down. Tech was down 0.5% on Friday. Catalyst Monday open gap, short it, hold 62.80 support, chop, break 62.70, play, SPY 620 puts or short ES, stop 63.35. If bulls smash 63.40 on dip buying, flip long, but tariffs say caution. Okay, guys, so overall, you can see the weekly picture that uh, institutions are hedging for the short side. I am bearish coming into the week. I have a bearish bias for the reasons that I gave above. Guys, this is not financial advice. I'm not a financial professional. These are, of course, data is subject to change, but for those reasons, I am expecting a down week coming into the week ending in July 18th, and we'll see how that prediction plays out. Thank you. Please make sure to like, comment, and subscribe.